Hello everyone, Steve Lentz here. I'm with Discover Options. Welcome to the Mentor Series. Let me switch my PowerPoints. There we go. This is the Mentor Series that we run every Monday at 1 o'clock Central. We have our team of mentors here, myself, Steve Popali, Frank Fahey, and Ken Dole. And we just kind of take turns on Mondays going over a different topic. Some of the topics are going to be discussed later in our mentoring class. Others are meant just for you guys. Today is a very advanced topic, correlations and diversification. And let me go to the next screen. And where it stems from is from our curriculum. For those of you that are not mentoring students, we have a great curriculum here. And what we're going to talk about today comes from the area right down here under money management. And so in our curriculum, we have levels 1, 2, and 3. And, you know, the first one is just long calls, puts, and option overlays. Directional spread trading is level 2. Level 3 is non-directional trading. And in all three levels, taught by our staff here, we have a money management component, and this includes the topic of diversification and correlation risk, and that kind of stuff. And that's what we're going to discuss today, is just a slice of this portion of the curriculum here today, all right? So you don't have to be a super math wizard to get this. Just kind of grasp the concepts. What we're going to do, and also we have this whole curriculum set up in futures as well. So if you're a futures options trader, we have a futures curriculum, and it's just wonderful. We have Ken Dole and Paul Forshoni as the two main instructors. And if you're at all in the market for options education, you got to give us a call, talk to James or Karen. We'll go over with you where you want to go, what we have to offer, and make sure that what we have is a match for where you want to be. And so really, the way we design this, for those of you just kind of looking at this, you can start out as a beginner over here and get to an advanced level in record time using the approaches here. And one of the things we do is we use exercises and drills to get you the skills that are required by advanced traders. And so today's exercise in diversification and correlation is treat it like a football drill, if you would. All right? Treat it like a football drill. Now, what has that got to do with this movie called Hitch? I don't know if you saw this movie. It's very funny. Will Smith is teaching one of his students, how to be more sociable with the other gender, and he is teaching him how to dance at a nightclub. And he tones down the dancing a lot, and he says, listen, and he just holds his elbows in and says, this is where you live, right here. This is home. And for some of us traders, we have our familiar markets, but sometimes we get a little wild and crazy. So in this show here, this guy right here, the guy that played on the Queen of Hearts, I don't know his name, you know, he was the guy that would go to nightclubs and go crazy with his dancing, and Will Smith is saying, no, you got to be cool. And so sometimes in our trading, we'll go off and we'll think we have an opportunity. And have you ever done this where you just go off on a wild hair and thinking, I'm going to buy some calls on this, buy some puts on that, or do this, and it's outside of your plan completely, all right? Just on a whim, on a wild hair, and it's wrong. Okay, so what we do at our mentoring program is we like to focus on specific skills, and we encourage all our students to focus in on a certain set of assets that just make a lot of sense. We want this to be home. Okay? We want it to be home for you. This is where you live, and that's what Will Smith was telling the guy. Look, I did the I call it the Hitch Dance, where you just put your elbows in and kind of go on one foot, sway to the other foot, kind of real lame kind of dancing, right? I did this at a wedding. My whole family was there. My daughters were mortified that I was doing the little Hitch Dance. All right? But this is home. This is where you live. So what assets do you have that constitute home for you, where you can say, this is where I live? Now, for many non-directional premium sellers, a lot of the guys, your home is the Russell Cash Index options, or the SPX. If especially if you have a lot of money to manage, SPX can take a lot of it, and it's a good place to go. Very liquid, can absorb a lot of assets over there. Okay, so, but some folks, and I get the students, and they're looking at stuff I never heard of, and you kind of go, well, maybe we need to go over this a little bit, okay? So, here's where we begin, and I'm going to walk you through an exercise, and treat it like, as I said, treat it like football before, okay? If you do a tackling drill in football, and I'm a youth football coach, except I'm not now because I got in politics and I got elected, and so I don't have time for doing that. But it's one of the biggest regrets. If there's a regret here, or a sad part about it is that I'm not coaching this fall for the first time in 20 years. I'm not coaching a youth sport for the whole season. But in football, if you're coaching defense and you teach a tackling drill, that tackling drill holds benefits across other spectrums of football playing. Likewise, the drill I'm going to show you through, just this exercise, is going to hopefully take you through a process that you can apply in your own trading. I'm not going to say that the 5 or 6 assets we come in for a landing on right now are going to be your little world, but the process of getting to these 5 or 6 assets is a drill and an exercise that I think will pay off for you in other aspects of your trading, okay? So, our goal here is to find our little world. Now, what I like to do, and you can do this in OptionVue using OpScan, is you can scan for those assets that have the tightest spreads on average between bid and ask, between the bid and ask price. Now, what are we doing here? I'm going to pull down 250. Let me write that. Just a little number here. 250 is the limit for OpScan results. I'm going to pull down the 250 option contracts that have relatively the tightest spread between the bid and ask price. And so, for example, perfect example is number 1 right here at the beginning. Ask price is $6.69. The bid is $6.68. That's a penny-wide spread on a $6.68 option. A penny-wide spread. I hope you'd agree, if you've been trading options very long, I hope you'd agree that that's pretty darn good. And you can see that the spider has several of these contracts showing up amidst these top 250 here. That's what we're aiming for, is the relatively the tightest spread between bid and ask. I'd hope you would agree that that kind of a list of option contracts is one that should interest us. All right, if there's tight spreads in the options consistently, that has a lot of ramifications, because now you can have a spread on in the spider, for example, and you could have a conditional order in to say, you know what, if the spider hits this price, then just execute a market order to get me out of that spread. And you're not going to get hugely taken to the cleaners that way. If you were to do the same thing in the SPX, okay, which is traded on one market, the CBOE, and the published spreads between bid and ask are extremely wide, even though it's really the highest traded, dollar volume-wise, highest traded market in the country by far, the published spreads are very, very wide. You would not want to do that. Here you have published spreads that are extremely narrow, and now you can actually, walk away from your computer with a conditional market order on and have some peace of mind if you're trading assets on this list. So that's why we go to this first, and we're going to whittle it down from there, and then we're going to look at correlation. Okay, so here we go. I'm going to take all this list, these 250, and I'm going to throw them into my OptionVue quotes display. All right, and what you do is you just select all these. Just do a typical Windows thing where you're selecting, hold down the Shift button and go down, right-click and send it over here to this tightest markets group. And at this point, you point your mouse in that little bar right there, tightest markets, right underneath the symbol. And if you right-click, it's going to alphabetize all these by symbol. And you could do the same exercise by name and last price, etc. We're going to do it by symbol. And what we'll do then is get this right here. Now we have an alphabetized list of all those contracts that showed up. So of the 250, you can see that Apple had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, around what, 15-ish or so, 13, 15 of those 250 were occupied by Apple. The Euro Index at the ISE only had one contract in its whole option chain appear. So here's what we're going to do. We're going to get rid of those that just appear once or twice. Those that appear just once or twice, we're going to get rid of here, because really that could just be a customer order appearing momentarily to create that tight spread between bid and ask. We want something that's more chronically, an option chain that has chronic tightness, and that means that you're going to have 3 or more contracts at least that appear with those relatively tight spreads. So when I go through and I eliminate the little ones and twosies, okay, I'm just going to eliminate the onesies and twosies like this. I'm then going to click the A button over here that's going to alphabetize what remains. And it'll get rid of all the duplicates as well. So all these Apple duplicates will get removed, and I'll just be left with one Apple symbol. And when I go through that process, here is the whittled down list of the tightest markets, those that have 3 contracts or more within the top 250 tightest markets. Just take a look there and see what you see, okay? Stocks, ETFs, you got the E-minis here, all right? And this was taken last week about 8 minutes before the close or so. So it was taken at a time where there was some pretty decent activity. Okay, just to give you a kind of a feel. Now, we can go many different directions here to get our little world in order. Okay, this means that we're not, what's not on here? Google's not on here. All right? For some of us, we love to trade Google. There's a lot on here. There's a lot of stuff not on here. Okay, but again, this is just one exercise. At this point, what I want to do is to just pretend that I'm talking to someone that likes to trade ETFs. Maybe you're a non-directional trader and you want to avoid the gaps that can occur with stocks. And maybe you want to avoid the earnings situation and the goofy announcements relative to CEOs or senior vice presidents who get lopped off the website like a guy happened at Apple over the weekend. Appears in the Wall Street Journal on Monday. All right? So you want to avoid that kind of stuff by going with ETFs. So if we just pull the ETFs out of here, okay, now let's just go through and pick these, and this will constitute our little world, right? Diamonds. Okay, we've got FXI. GDX. I went with GLD in that sense because it traded so much more. I went with GLD, IWM, and the Qs and the spiders, right, and those are 6. 1, 2, 3, 4, 5, 6. I went with GLD for the gold. All right, now that's the ones we're going to pick for our little group. This constitutes our little world. So let's just pretend we have our little world going on, and we're going to start doing our spreads, directional, non-directional, whatever. However you like to trade, this could be our little world here because we know they're tight markets and these are ETFs, right? Not so fast. All right. What if you like to trade, say, let's say that you're a butterfly trader and you like to trade neutral butterflies. And so, well, what happens if you put on an at-the-money butterfly in the Russell and the spider and the Qs? Well, the market could have a big day either up or down, and you start noticing, gosh, every time the market moves up, my positions suffer in all 3 of these markets. That's called correlation risk. Yeah, you're in 3 different markets. yeah, they look to different groups of stocks, but they're highly correlated. Okay, you may as well just put one butterfly on in any of these three. That's kind of going to be your thinking after a while. And this is an area that gets people in trouble because you may think you understand correlation risk. This is kind of too obvious of an example to be hidden, but I'm just making the point because I've learned the hard way. I may think I understand correlation risk. I may think that I've accounted for it, and then it turns out that I didn't. Okay? And I'm not going to, in this business, you have to learn to have a short memory. You learn, make adjustments, move on, but you forget the part that caused emotional pain, all right? That's going to keep you from moving forward. And so I'm not going to rehash it too much, but I've learned from experience this is something that can be tricky. It can be deceptive in that it'll fake you out a little bit. You think you got a handle and you don't. So what we're going to show you now is where do you go to really quantify some of the correlation possibilities here. Let's say that you have your own little world. Let's say that this is your world, these 6 assets here. All right? What I'm going to show you is a way that you can measure this and start assessing your level of correlation risk. Let's say that you take the GLD at the top, gold. Down below you have the spiders, and this is in Metastock, by the way. I use Equus's Metastock program to do this kind of analysis I'm going to show you. And you might look at this and you're going to notice that, yeah, there's a degree of correlation. Over here it's going up, here it's kind of going up. It's not perfectly correlated. We can see, kind of a gold holding firm while this kind of, is wavering a little bit. Not perfectly correlated, but you definitely see some similarities. All right, so how do we assess correlation? Okay. Here, what we're going to do is kind of back into a correlation coefficient. And here's where it begins. All right? This is where it begins. It's called a correlation coefficient. It's a way of evaluating how much 2 assets or 2 sets of data or 2 population sets correlate with each other. And it's a measurement, and it's between -1 and +1. Here's how we get to it. We begin, in this case, we're going to use a 20-day correlation coefficient. And geometrically, it looks like this because this is what it corresponds to. It's as if we took 2 different linear regression lines, one for each population set like this. And we're going to measure the angle between the 2. Now, what is a linear regression line? And time won't let me dive into that part of it right now, but basically, it finds the line where the average distance from the data points to the line are the smallest. All right? That's the best way to describe it. It's the line that you drew that if you were to measure the distance between each data point and the line, that it would be the smallest. Okay, so with that done, we can take both lines like this, and of course, accounting for scale and all that. Basically, here's the idea: you put them together and you calculate the cosine of the angle between the 2 lines. If the lines are right on top of each other, there's a perfect correlation. The cosine would correspond to a number of +1, basically. Okay, if the lines were at a 90-degree angle, all right, then you would have a cosine that would approximate. Well, let me think here. Let's see. If they're a 90-degree angle, they would be perfectly uncorrelated, so that would be a -1, and something right in the middle would be a cosine corresponding to 0. You get the picture here, okay? And I'm showing it geometrically. You can dive into the concept, but I think we're just trying to see how well these 2 correlate, and that's what you get then. +1 is a perfect positive correlation. 0 means there's no correlation at all. -1 is a perfect inverse correlation. So what we can do then is take the 20-day correlation coefficient, and every single day we begin to measure it. So here on the far right, if we were to measure it, we could tell, yeah, you know, the lines were pretty darn close there. All right, and the value we had, if we calculated that, the correlation coefficient over the last 20 days is at 0.85. That's pretty close to a value of 1. And you might think, gosh, you know, in the last 20 days, 0.85, wow, these are correlated. I don't want to trade both of these using the same direction or the same strategy. I better diversify and not trade one if I'm trading the other. Well, you can't just stop there. You can't just take the last 20 days and go, aha, that's the correlation coefficient, I'm not going to trade those now. What you want to do is look back farther in time, because you'll notice that there were times where, look at this, where the inverse correlation got to be pretty strong as well, where the two were inverse correlated. And this was just going back a month ago or so. In fact, if you were to go back in time, you could see that the correlation goes from positive to inverted to a strong degree, swinging way back and forth. And on average, okay, on average, over the last year, the correlation would average out correlation coefficient to just 0.13. That's not very much. That's pretty darn close to 0, meaning on average, they're really not well correlated at all. So, and you can kind of see just long-term, look at this one's going down, this one's going up. There's periods where they're correlated, periods where they're not. Really, these are two markets to consider trading together, you know, knowing that you'll have periods where they are correlated, periods where they're not. Okay? So, that's what you want to take yourself through, is take a 20-day correlation coefficient and then take the year-long average of that to get a feel for the long-term correlation between any two assets. All right, now oh, okay. By the way, if you wanted, now you could do this in an Excel spreadsheet if you have the price data. Okay, that's something I'm, going to start working on. I've been using Metastock for a long, long time. And by the way, if you wanted a trial of this, you can go to metastock.com/OptionVue. There's a promo code in there if you want to go down this path, because this is a real easy-to-use tool. Okay, so what we do then is here's the final part of the exercise, folks, is you're going to lay out a grid. And you would lay out your 6 going across and your 6 going, along the columns here. And you just start simply filling in. Okay, I'm going to compare gold to the spiders. I came up with the 0.13 for each of those. I mean, really, you can just, I like to fill out the whole grid to get a good spatial view of this. Okay, now we have to go to another pair. So now we might go and look up the Russell and spiders. Let's take the Russell and spiders. So now we're going to compare spiders and the Russell. So we're going to fill in this one, and we're going to fill in this one. See that? Okay. So we get our two we get our two charts, and you can kind of tell instinctively, gosh, they really do look like they correlate quite a bit here, right? Okay, and looking at it, you're right. I mean, now there's some seasons where if you look real close, that's why this line dipped all the way down to almost, to 0 here. Didn't quite go negative, but it really plummeted quite a bit for just a short period of time before climbing, and it hovers right around 0.8 and 1 most of the time. Really, I mean, it's very, very well correlated, so it ends up being a 0.86, very close to 1.0, a positive 1.0, which is perfect correlation. So these are two markets that, it's definitely above that 0.5 mark. It's approaching perfect positive correlation. These are two that if you trade one, you probably don't want to trade the other. And if you do, you would cut your size in half for each of them. But you just got to be aware of this. So now we come into the grid, we fill out these two boxes, and I took the liberty of just assuming you didn't want me to walk through all of these. I'm going to fill in all the rest, which I did in preparation for this, and there they are. So take a look. I'm going to get a sip of a carbonated beverage, not coffee. We're laying off the coffee in the afternoon here today. Let's see. Yeah, John is suggesting we look at TLT and FXE in the correlation chart. That might be interesting, John. And John, I'm going to present this tomorrow as well in our mentoring class. I might expand on it with those symbols. That's a good idea. It's been a while since our mentoring, our Inside Wire. I do a weekly Inside Wire session, folks, for those that are in level 3 or higher. And we get together weekly, and I go over a different topic, and this was a topic about 3 years ago, kind of just following up on what we teach in our money management, and you know, this will be a nice little brush up, and I'll include those symbols, John. Sounds good. Okay, so have you gotten a chance to look at these? I'm going to color those in that are over 0.5, right there. Those that are over 0.5 are right there, and you can kind of tell the usual suspects here. Diamonds correlate well with spiders, Russell, and Qs. Spiders correlate with diamonds, Russells, Qs. Diamonds, Russells, Qs, and spiders are all four correlated very well with each other. All four of those seem to be well uncorrelated, or less correlated at least, pretty strongly with FXI and GLD. Look at all these. Pretty low numbers here, right? Okay, so that's a good thing. That's a good thing. They don't correlate with each other. So right now, it looks like FXI and GLD are two items that we're going to want to have in our little group here, our home, as Will Smith would call it. And then the other four, we want to be very careful about loading up in more than just one of those, because all four of them correlate very well with each other. And so with that knowledge, we can now move forward in divvying up our option trades. And so is that the end of the story? Well, no. At this point, knowing where our home is at, these six, we know that two of them are really good ones for consideration. The other four are very well correlated. We want to be careful. We now have to look at their volatility charts, especially, and I assume many of you like to trade non-directionally, butterflies, condors, or calendars, that kind of thing. Well, you need to be aware of the volatility charts, and this is just my last point here, in that one thing we do at Discover Options here is we pay great attention to the overall long-term volatility profiles here. Like, for example, in the diamonds, over the last 6 years, on average, implied volatility, the blue line, has been at a 20.2, which is about 1.5% higher than the statistical volatility of 18.6. Now, what does that mean? That means that, on average, the time premium in the options implies higher volatility than what actually comes to pass. And that kind of a market is something you want to look at for premium selling. Credit spread, condors, butterflies, calendars, where you're theta positive, where you're bringing in daily time decay. Look, if it worked out that on average, the statistical volatility of the market, the red line, how much the market actually moved, if that red line was higher than the amount of premium you're collecting and implying, well, now you're selling premium in an undervalued market. That's not good. This way, you're selling premium in a chronically overvalued market, and that's a good thing. Okay, and so we like to then look at that on all of our assets that we're going to call home. Here are the top 6. I drew a line here. Below I added a few. But here's the diamonds I just showed you. Let's look at GLD. Chronically overvalued, yeah. Look at the Russell IWM. Not so much. Now look, when you go down to the Russell here down below it, the RUT, even though you don't have the tight spreads, you can, if you can watch your screen a bit and you can put in limit orders and get that, take care of that a bit better. Well, now you have in the RUT options that are more chronically overvalued than what you have in the IWM. Isn't that interesting? See that? Very interesting stuff. All right. And also it's interesting, too, how the RUT seems to have lower statistical vol than the IWM, even though they're the same market. That's an interesting little, I wonder why that is. 1.7% lower in the RUT than in the IWM. I'm going to have to pass that by our, Jim and Len and see why maybe that is. That's very interesting. Okay. Let's go up to the top right. Spiders. Chronically overvalued, but not by that much. In the SPX down here, you have a full 1% separation. Up here, you have just a 0.6 separation. Interesting. Okay, the Chinese ETF, look at that thing. Now, you got to watch the overnight gaps and all that, but boy, you're getting a lot more premium on average because of that. So that's something to sit up and take notice. And of course, in the Qs, you have a chronically overvalued situation, but not to a huge level. Anyway, chronically overvalued situations all over, some less so than others, but that's something you want to consider as well in evaluating your strategies. And again, that's a topic we dive into a lot in our mentoring program. Okay, any other questions? Here, we're back here. So I hope this exercise has been helpful for you. Maybe it'll prompt you to kind of take a look at your group of assets a little more closely. Maybe try and explore some correlation tools to try and figure that out. I know we have an intuitive feel that spiders and IWM are, move this in tandem quite a bit. But if you want to diversify, okay, that's the process you got to go through, what I just showed you there, okay? All right. Anything else? All right. Okay, folks, those of you in the mentoring class, if you're in level 3 and you're signed up, okay, we got a thing from Raj here, just a second. At the current level of implied volatility on Spider or Diamond, is it better to sell premium like iron condors, or is it better to put on calendars? Raj, one thing we like to look at is the direction of statistical volatility. Now, if a lot of educators out there say, you know what, you want to do calendars only when implied volatility is really low. Now, that's in the context of thinking that implied volatility, because it's low today, is going to go up tomorrow. Now, how many of you know implied volatility can be low today and be lower tomorrow? Okay? So we don't really ascribe to that. One thing we like to look at is a degree of, let's see, we like to look at the trendiness of statistical volatility. Yeah, implied is low. It's at, it has been lower than this. We know it can certainly go lower. It's been higher than this in the last year. But what we like to look at more is, and if you're going to time this in terms of strategies, we like to look at any neutral strategy getting a little bit more aggressive with it when statistical is trending down. If statistical is trending up, like this, the red line trending up, and the market is getting choppy, and the daily bars are getting wider and wider, that makes it for a more difficult time. Okay, we don't really like to look at implied volatility at its current level here as some kind of a static number, and you can say, well, if it's above 10, we do this strategy. If it's below 10, we do that strategy. No, no, no. Don't like to look at that because it's all relative to how volatile the market actually turns out to be. So right now, statistical has been going down. It's been curling up a little bit. All in all, it would be, labeled in a downtrend. It can go lower than this or hover down here. Okay, this kind of look at the choppiness here that we've had. That's an ideal market for selling premium in a neutral way. Okay, and so that's kind of, Raj, that's kind of the perspective that we have on volatility. Okay, we don't like to look at the current levels between implied and statistical, but we look at the direction of the trend of statistical for that. Now look, all this, okay, you mentioned iron condors, Raj, and butterflies. Look, all this assumes that you know how to make adjustments in those non-directional strategies. Okay, and that's what level 3 is all about for us. Level 3, condors, calendars, butterflies, you have to know how to adjust those positions. Okay, and if you don't know how to adjust, you're just going to put them on and wake up a few days later or a few weeks later, you're going to fail. So these non-directional strategies are used by professionals, and that's who we have on our staff, are trading professionals managing a lot of money, and they're mentoring on the side, helping people get to an advanced level in the quickest time possible. That's what we teach, is adjusting these neutral positions. That's what all the pros do. You never just put it on and shut your eyes and open them later. All right. Excellent. Folks, thanks so much. We will be back next week with another mentor. I believe it's Papali, Steve Papali, if I'm not mistaken. Back next week on Monday, same bat time, same bat channel. Take care. Have a great week. Bye-bye.